Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful when the world's on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you got a good spot. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun.
Good morning, everybody. All right, let's see here. Make sure the music's going here. So, we had an interesting day yesterday. We had it was kind of a quieter day. Apparently, a lot of foreign markets were closed I wasn't aware of, but we did get some action after we left that concerns me a little bit. Now, let's see what we did overnight. See how things went. Tell you what, I like every time I start saying something, I have to pause because it sounds so different to me with these new headphones. All right. So, we did have a little bit of a rise through the beginning of the morning, but then as the day went on, the treasury started to sell off again. And this was not very well correlated with any other kind of movement in the markets. So it does look like that people just started selling treasuries off again for some reason. Another kind of like basis trade blowing up. You come over here to the S&P 500, well, that was turning down the whole time. So the initial buying in the treasuries was probably just risk off positioning coming from the equities. But then the S&P 500 continued to fall and the treasuries fell along with it. Okay, here you got oil's kind of doing its thing. It's starting to form a new range between like 62 and 64. Gold just looks absolutely amazing, and it looks like there was another, was that overnight? Yep, there was another huge move overnight in gold. Gold and silver are like the place to be, although silver not as much. Not as much, but still pretty okay in silver. Copper is kind of matching silver, so silver is kind of forming more like a traditional metal. But and then we got the Japanese yen. The Japanese yen is kind of looking strong too, and a lot of this dollar weakness, maybe it's coming from the Japanese yen, although I think it's certainly coming from combination of currencies. There was a lot of money parked in the United States during the Biden years because of a combination of factors like interest rate policy and things like that, and it is leaving. It is not a good thing for the dollar to be over 100, and I really don't think that we will see 100 again for a very, very long time, unless there is like a worldwide recession and money comes back. So, but we don't want it to fall too quickly. And this is pretty fast. Okay, this is a pretty fast and dramatic move. But overnight, nothing too crazy. Nothing too big. And Bitcoin trying to build on that little move up that they had, but it's kind of struggling. I'm kind of wondering, because this is not trivial. Okay, this move right here is not trivial, but I am kind of seeing a little bit of, it's just like the interest isn't there, So that's where we're at. So over here in the treasuries, well, the range this morning is pretty tight, but I am seeing some evidence in the overnight, like cumulative deltas and everything, that there is some activity going on out there. So let's just kind of give it a little bit of time, see if it does anything interesting. If we want at least one female person during the live, Seth has to clean shave like on the YouTube profile picture. Wait, what does the YouTube profile picture look like? Oh, you mean this one? You mean this one? Yeah, that is. Well, that's not clean shaved. That's like that's like 1 day after shave. I don't get it that far down. It is kind of time like I don't know. Tried to clean it up a little bit. It's kind of in that weird space where it kind of feels a little scraggly. And then I give up on it. If I let it go a little bit further, then I get like a real beard. But it's too gray, man. That's the problem. It's too gray. I think if I was gonna have it long like this, I should dye it or something. Oh, hey, I can see here Ninja Trader's stream is going again. So they were saying they were going to change things up with the stream, and I hadn't heard what they had done with it. But it looks like they got a completely different set of people now. Oh, and they've got Anthony Crudelli there, too. Well, that's interesting. Maybe I'll check that out after, maybe later today. See what they're up to. Let's see here. Oh, yeah. Let's keep Truth Social up today because I really think that you're going to get some more noise from Donald Trump this morning. So I don't know if you saw, you know what? I didn't post it on YouTube. Maybe I should have posted it on YouTube too. Maybe I'll do that today. But, ooh, we're getting a little bit more of a, yeah, that recent one is kind of calling my name. Calling my name. So Donald Trump has been attacking the Federal Reserve. And, you know, I was kind of looking at it yesterday and kind of realizing, like, wait a second. Like, I don't think that most of the people online that are talking about this really understand the situation. Because the Federal Reserve is almost certainly going to cut in June. Actually, let's pull that up. CME group /market/interest rates.html hash tools CME Fed Watch. All right. So we have meetings in May, June, July, September, October, and December. And for May, the market is pricing a 92% chance that there will be no change. Okay? But when we go to June, there is a 62% chance of a cut. Okay, it was actually 70% earlier. Let's see here. Compare. So, few weeks ago, what was it? A month ago, it was 67% chance. But that probability hasn't changed too much. Okay. Markets are fairly confident. And I'd say that that's a pretty strong probability this far out that they will cut in June. Okay, and Donald Trump, he's mad that they're not cutting. So this tweet storm that Donald Trump is fuming over every day is literally about whether the Federal Reserve cuts in June or cuts in May. Unless he wants like an emergency cut or something like that, right? So this goes back to the whole thing. Remember during the pandemic when there was like the Omicron variant was coming along and we were all watching this and we're like, we're going to get inflation. Like the market is just going crazy. How can you let the market move up this much and the housing market get as crazy as it was getting? And, you know, you have to raise rates. This is just ridiculous. And everybody was like, no, you can't raise rates because what if their Omicron variant comes along and we have just the whole thing all over again. Well, eventually they kind of decided, you know what, like, we are getting inflation, and we're concerned that further shutdowns could just create more inflation. So we do need to raise, and that's when they started Omicron. You're right. Oh, Omicron? Was it? Yeah, I think you're right. It was Omicron. Omicron. But is it O or is Aw? It's Omicron. Anyways, that's when they raised, right? And, the Federal Reserve, they talked about it at the time, too. They were like, well, like, we could cut this time or next time. We're not sure if it really matters. The effects of interest rate policy is lagged, etc., etc. We did find out that the reason that inflation got as bad as it did was because of the monetary stimulus that was coming in that the Federal Reserve needed to cut earlier. But it was probably by more than a month. Okay, it was probably more by like 3 to 6 months earlier that they should have started hiking, rather. Okay, so, but when it comes to the trade negotiations, could that matter? Yeah, because if the markets were doing better, I think that would help Donald Trump's negotiating position and all of this. So I think there's two ways to kind of take all of that information. One is, well, everybody that's like really, really freaking out, because I do see some people, they're like moving money. They're really concerned. There is, especially on Reddit, there is a lot of discussion about this. Oh, by the way, we need to turn on our robot. Let's make sure we do that. Probably not something that I think should really be like the first thing on your mind as an investor. It's probably a distraction, okay? On the other hand, it's also like Donald Trump shouldn't be as uppity about it as he is, right? Does he realize that he's really flipping out? Like tweeting up a storm and freaking, upsetting everybody over a month? I don't know. Now, there's some people that are concerned that he would remove Jerome Powell. Probably not. I think that if Donald Trump was really going to try and remove Powell, that he would have already done it. He would have done it. If he could have, he would have. But I think the reality is he knows that it would cause so much chaos in the market that it's just not even worth trying. Right? Now, he could try to convince Powell to resign. Who said that? Vital said that. My bet is Powell will resign. I think that is a more realistic scenario, right? Like, he could say, well, if myself and the president are that far out of line, out of sync, then it's the best thing for everybody for me to step aside so that he can install somebody else, right? But with the way that things have gone, I don't think that Powell would resign. I don't think that Powell would do it. It would be like, because him resigning, that would be pretty disruptive to the markets. I think that it would really cause people in the future to question how independent the Federal Reserve can actually be, et cetera, et cetera. So I think that what's going to happen is, I think that nothing's going to happen, and eventually Donald Trump's going to stop tweeting about it. If I were Powell, I'd be tired of this shit. I think so too. Like I can imagine. Well, because if I was in Powell's position, I think I would be doing things differently, but I think that there would probably still be something to criticize. This is the thing that I've always noticed about the Federal Reserve, is that you can't win. As the Federal Reserve, you can't win the public's affection, because it doesn't matter what you do, there's some portion of the economy that is unhappy about what the current interest rate policy is, right? Like we had low interest rates, like a period between 2008 and 2020. So 12 years of the lowest interest rates in history, the most stimulative, easy markets, and we've had some of the longest bull runs in history because of that. And every step of the way, every day, there was somebody I saw online whining about how interest rates should be higher. And I remember even here on this stream talking about it and saying, like, you guys want interest rates to be higher, but you know that like a decade or two from now, when we have more normal interest rates, you're going to look back on this time and realize that it's a fever dream. And it was the case. Like those low interest rates, I would love to have those low interest rates back. That'd be so great. For us in the markets, that's amazing. But there are some companies, there are some people in some industries that don't do as well when interest rates are low. Right? So there's always somebody unhappy. And I would think that it wouldn't matter what I was doing as Federal Reserve Chair, that there would probably be some criticism there. And unless you basically were like feigned absolute fealty every time that Donald Trump started talking about it, I think that he would be, he'd be after me. Now, the thing that I would be doing differently is that I would be saying, there is a trade war, and we believe that as in the Federal Reserve, that it is our responsibility to try and support the president and their goals as much as possible within the boundaries of still maintaining price stability and maximum employment. And under that kind of set of guidelines, I think that we could cut in June, or sorry, not in June, in May. I think that we could cut in May to try and help the trade, because we're going to cut anyways, and I don't think that a 1 month difference is going to make a difference, like to inflation or anything like that. I think that all of the data that we're getting coming in says that like the cyclical inflation that we were kind of concerned about at the beginning of the year flaring up is not really taking hold. So I think that it's safe to cut interest rates in May and do it sooner in order to try and help the president in their trade negotiations. And I would be outright saying that. That would be the different thing that I would be doing. But I think that he would still have a reason to criticize me. A narcissist always blames others if the FM. Well, I don't think that Donald Trump is a narcissist. I believe that Donald Trump plays a narcissist on TV. I think that Donald Trump is ADHD. So I don't know. Does it really matter? I don't know. I'm going to go into it anyways, okay? The thing with a narcissist is that a narcissist is so concerned about how they are viewed by other people that they kind of lack the ability to empathize with other people or see things from other people's perspective. And that is certainly not Donald Trump. Donald Trump has the ability to empathize with his constituency and understand a situation and, listen to advisors and take feedback and so forth in a way that a narcissist doesn't. Okay. If Donald Trump was truly a narcissist, then his campaign would have never have made it out of the Republican primaries. It would have blown up halfway through the Republican primaries when he made his first campaign manager change. Because that was hey, things aren't working and we're going to change course. Narcissist would double down on that current trajectory. Donald Trump has a tendency to make a hard left turn when you least expect it. He will just, he'll be saying all this stuff and he'll be tweeting about it a ton. And then all of a sudden one day it's just like his opinion is completely different, right? He has an ability to change his opinion in a way that I have never seen in a person. It's really quite startling. And I personally, I think that that's something that could only come from somebody that has ADHD. I saw an interview recently that ADHD does not exist. It's a reaction to stress and an inability to fight or flight, so they redirect. No. But I have seen that stuff. I think I can recall exactly the thing that you're talking about. Because there's this guy on the interview circuit that it basically pushes that ADHD is a trauma response. He's full of shit. So here's the thing. We have very strong genetic evidence about what causes ADHD. We understand the neurochemicals that are involved. We understand the genes and how mutations in those genes result in different chemical behavior in our brains that results in ADHD behavior. So ADHD is probably the most studied medical disorder in the world. So the idea that all of medical science has been getting it wrong and it's actually just some sort of a trauma response is just the most ridiculous thing imaginable. So we understand what causes it very, very well. Okay. What we don't understand is how does ADHD actually exhibit itself? What is the best way to deal with ADHD? And that's where I think a lot of research is being revisited. People are changing a lot of things. I think that another thing that's going on in that world is that there was a lot of basically in the 90s, they said, oh, you have ADHD? Well, there's this medication and it treats ADHD really, really, really well, which is true. The stimulant medications, they treat ADHD really, really well. The problem with that is that it is a developmental disorder, which means that your brain is developing differently from an average person's because it doesn't have enough of those neurochemicals, right? So taking the medication doesn't necessarily just make those developmental changes go away, right? And so what you have to do is the brain has to develop. So it's not enough to just put them on medication. There is a lot of support and ongoing support that you have to do. And we don't do a very good job, especially with children. Like, it's really hard without being there and holding their hand 24/7 and showing them what to do to build those skills and everything. It's really hard. But they're starting to realize that like you need more support for them than you can't just give them medication and then write it off. The synthetic crystal meth. Well, it is an amphetamine, yes. It's very different from methamphetamine, though. We're getting right up in there into the stop out zone here. Pretty significant amount of market order imbalance too, by the way. Is it a good idea to open a trade within an hour before the market opens, or is it better to wait until it starts on average? Well, so if you're just talking about like the futures start, you know, like it's things start 6:20 my time, 8:20 Eastern time, and let's say that it's 7:20 Eastern time, and you're gonna get a trade in the treasuries, that's okay. If you're seeing a strong flow in the overnight, and you have reason to believe that that flow is going to continue through in the regular session, then getting in the trade before everybody comes in and starts trading is a great idea, because when they come in and they start trading, all that's going to happen is you're going to get more flow and even stronger imbalance in your favor, right? If we're talking about the equities, the situations where you start to get that momentum and it really continues through, like 2 hours before the S&P 500 opens, is kind of rare. When you do start to get momentum an hour before the S&P 500 opens, it's usually because of economic news. So that could be a reason to take it. But most of the time, they really don't start doing anything until about right now. About right now is when you'll start to see the S&P start to do stuff, right? So I would say you could take trades, you know, under a normal circumstance. It could make sense to take a trade 30 minutes before the S&P 500 opens. On the other hand, you know, like trading, like especially the very beginning part of the extended session, usually not a very good trade, right? So let me try to generalize here. What matters? What matters is future orders. Is there going to be a strong imbalance in future orders? If you have a reason to believe that those future orders are imminent, take the trade. It doesn't matter what time it is. But there's a lot of things that we know about time that can help us predict future orders. And we should factor those things in to kind of help time our trades. I find myself in similar trades, except for you're usually late in comparison. As of recently, that's probably the case. But normally I find that I am in the trades too early. I usually will get in, like this trade. You're saying I took this one too late. Well, okay. I might have gotten in right here. So I think I could have gotten in at 25.5. So that was a little bit late. But, you know, when I got in, when I took the trade over here, that is, it kind of came back on us a little bit, didn't it? So, you know, I in some respects, I was a little bit early. I tend to get a little bit adverse excursion. And normally I'm too early. Too early, and the flow does come, but not until like there's been some move against me that really makes it hard, you know? Now the robot is doing something kind of different, and that kind of I kind of feel is going to be late compared to where I would want to get in, at least. The robot is usually late compared to where I would want to get in. But the robot takes a lot more trades and catches way more good moves than I do. So what you gonna do? I think the reality is that timing things is really, really hard. And I have yet to find some sort of a technical setup that really, really minimizes the adverse excursion that you get. Most of the backtesting and research that I've done, it just is saying the earlier in the trend you get in, the better. But nothing that reduces adverse excursion. So. Now on the split side, I kind of see a lot of you taking profits, and I do feel that taking profits at 28.5 is prudent, but I'm kind of playing that I think it's going to go sideways for a while. It's going to rebalance a little bit, and then there will be a further move up. So it kind of depends on what time frame I want to play this as. The concern that I have at the moment is that it's going to come back. Well, maybe, you know, I think it should stay around 28. If it comes back to 26.5, I'll be upset, but it might stay there. And, you know, when it goes up for a new high, it won't be until long after I'm gone, is kind of my concern. So I was kind of eyeing an exit at 28.5, and I didn't quite see a good opportunity. Maybe I should have taken the 28. What is a fractal market profile? Never heard of that. Oh man. I'm honestly, I'm really, well, there's a fractal markets hypothesis. That's something different. Maybe I need to put it in quote marks. I'm a little bit skeptical about things relating to fractal markets, because although I think that there is something there, that there is some degree of fractal nature, the whole thing about fractals is that you can't really predict them. You have to go through the calculations. So I don't see how you turn that into an indicator that actually gives you a predictive ability. Now, nothing comes up when I search for fractal market profile in quote marks, unless I'm... No. Just fractal market analysis. Okay, how about fractal order block? Oh boy. Wow, it did come all the way back to 26.5. Although not a super strong decline in cumulative delta on that. I'm going to leave this order here. It sounds like ICT nonsense. Because ICT uses the term order blocks, and so I've started to see retail traders use the term order blocks in a way that does not really make sense with how the professional world uses the word order block. You know? I don't know. It comes back to, have you seen any empirical data on them? Like, if you can show me a study or maybe like a YouTube video or something where somebody has produced empirical data, we can go and look at that. Set everything down and look at a naked bar chart. Okay, so do you have any empirical data about ways of analyzing a naked bar data that shows a statistical edge in there? I don't think you understand, man. So like when we get into this, the thing that's going through my mind is what is the thing that I have not said that I need to say that helps him understand why it doesn't work that way. But I just come back to, okay, but I think he's already been listening when I've said this before. You can't just look. You as a human being, your mind does not have the capability to view enough data to actually see if there is something there or not. You're going to be looking at something that's completely random, and your brain will think that there's a pattern there. But if you actually really are able to look at like 5 years of data, like this really huge data set, and really analyze it, you're going to find out that it actually is random. So we can't just say, oh, we've looked at it, or I traded it and it seemed to work for me, or like we can't say that. That's not enough. We have to do an empirical study and actually prove it with the data. Why should I waste my time? You realize that if I go in and I look at every little thing that retail traders claim it works for them, you're just going to spend an eternity analyzing technical analysis setups and never go anywhere. Like there has to be there has to be like a higher threshold there, right? Of when is something actually worth looking into? What's my threshold? Somebody has empirical data. Let me take this from another direction. I refuse to believe that there is some sort of strong technical pattern staring us right there in the face that we can all take advantage of that somebody hasn't written literature about. Like how could something be like that? Like it's there on the chart, you just have to look. If it's that simple, why hasn't somebody at a university gone and done a study about it? It makes zero sense. Because you're talking about the sort of a thing that everybody is looking for, man. Everybody is looking for it. If it was really that simple, they would have done the research. And you want me to spend hours of my time researching and doing the analysis myself, only to come in and find out that it's random? Come on, man. Well, it's interesting that it came back right to 26.5, isn't it? That's starting to build out a pretty good profile, isn't it? So I think the thing that kind of like triggered all this was the discussion, like, is there something that can really give you, like, reduce adverse excursion? And I don't think that there is anything in the data that can do that. Like, I can see how long a trend has been going on. And so the earlier that I get into a trend, the better, generally speaking. And if I'm able to filter that into times when I have a really good predictor that there is going to be a trend, which kind of comes from fundamentals, then that helps, right? But I don't see how any of that could result in something that reduces MAE. Unless you really you're really getting like a really strong flow coming through. We keep saying the same things over and over. Well, because people keep bringing the same. It's not me. It's not me. It's the retail trading community is not progressing, right? 3.4K offer in ZT. Okay. Right? If the rest of the retail trading market was along with us, they would all understand these things and nobody would bring it up anymore. And we would be bringing up new things and new research or new areas of research, right? Granted, there are some new areas of research that we are kind of getting into with machine learning, but what percentage of the market? Well, of the market, I'm not so sure. So, the general rule of thumb is that retail is like 30 to 40% of the market, right? But I don't know what percentage of that would be considered like day traders, for instance. I kind of suspect that in futures that it's a very, very low amount. I'm kind of think that and that it's in fact decreased. Because it seems to me that almost all of the retail traders are doing these funded trader programs where you're basically on a sim account the whole time. So it may be the case that the number of actual volume out there from in the futures markets from retail day traders has gone down. Right? But if we were to look at retail day traders and like what percentage of those are just gambling, I would wager 99% of them. 99% of them. Now, there's also kind of like, what do we define as pure gamblers, right? Because there's always risk involved, right? Nothing is for sure. So I think that you could kind of like put it on a scale, right? Like a scale from 0 to 10, 0 being that there's absolutely no edge to what you're doing whatsoever, right? And a 10 being like you have inside information, right? So if we were going to draw a distribution of that from 0 to 10, I think that the distribution probably looks something like this. Damn, that order hit. There was some pretty strong buying that came through there for sure. At 28. Yeah. I can see it. It wasn't big enough to like trigger my like audible alerts, but there was like 2 1,000 lots that hit through that. Anyways, so yeah, most retail traders, and like where would I put myself from like 0 to 10? I think that we're like a 4. I think that we're like a 4. Like sometimes we have a really, really good idea of what's going on, but my ability to know if we really have that or not is somewhat limited. And so I think that there's still a great deal of luck involved. Put it that way. Even if we are utilizing more edge than most participants. Right? So far, the flows have definitely been long, and it does kind of look like that they're going to go and push those the top end of this. Now, the interesting thing here is that it's not really coming along with any like strong move in the S&P 500 or anything like that. So we're about 15 minutes out. So that's the next kind of piece of information that we have that we can kind of consider in terms of the flows. But I'm hoping that that means that we could get another little push up here before, you know, in the next 30 minutes or so. Otherwise, this push kind of happened at 6:56. So I don't think that, you know, we would be like through the impact of it for another 30 minutes or so. So I think we should just note that the order book still appears a little bit damaged to me. I don't know though, the robot is keeping it. The problem that we're going to have with the robot is that it wants 10 ticks and it's going to stay in it for an hour unless it gets to 10 ticks, right? When did it take it? 6:45. So yeah, he's going to be in this for another 30 minutes. We'll see. Should be interesting. Still kind of waiting for Donald Trump to tweet something. I don't think he's done it yet this morning. Oh no, he has. Very new book by Dana Perino, a Fox News star and a very good person, is called I Wish Someone Had Told Me. The title says it all. Much to be learned about life and success. Get it now. That's it. He's recommending a self-help book. That's not something I've seen him do before. Oh geez, so there was a thread on Reddit that was like, what was your worst story about getting filled? So I told them about that time that we cut 10 points of slippage. Usually when somebody asks that, they're kind of asking like, okay, like what's the worst loss that I could possibly have, essentially. And when you tell them that it could go 10 points against them, that scares them. Uzi, you're totally correct. You have a day job again, you can trade pennies in the micros again, big dog. Yeah. And you know what? I could have done that on this one. I kind of said when I was in the shower, because I did not sleep very well last night. I feel a little bit more free today. So I don't really feel like today is the day to start, but I can. And you know, I didn't really feel like I had a really strong predictor of order flow today. This trade that I'm taking on the DOM, I didn't take it because I thought that I had strong predictors of order flow. I took it because I was trying to get myself back into the flow of it a little bit. And I could see that the flow was clearly going one way, so I was like, okay, let's just go with it. Like I already feel like I've gotten more from it than I probably have any business having gotten, you know? But if we really think that we got something, I definitely do need to go and take a real trade. Absolutely. But I don't think today is the day. I think that today is a day where I'm really likely. So like the fact that I took this on sim is maybe even kind of evidence of this. Like today is a day where I'm going to be likely to overtrade and so on, so on. So probably not the best day to start taking risk. Plus, you kind of got to ease into it a little bit anyways, right? I don't know. Now, on the other side of it, because I'm not here for very long, I kind of feel like that's going to have to change the way that I trade a little bit, yeah? Like, I think that I'm going to have to be going for more moves like we've seen. And not really going for the really big all-day trend, you know? Because I'm just not here long enough to get that from them. There's not enough disk space available. Uh-oh. Better do something about that. There we go. There we go. I think we're okay. So let's see here. It came back 2 ticks. Kind of. It was really centered around 28, so. There has been 6,000. I mean, I could have gotten filled at 28.5, right? I did kind of think that one was going to go further. That, I don't know. You know, when it came in and we pushed back up, I did feel like it was a little bit impulsive about it, wouldn't you say? Like it was a short burst of volume and then it kind of subsided again. So I'm not really sure what the deal with that was. It might have been something endogenous, so you got to be careful. I don't think that the chances of it like really continuing to trend up are as strong as I want to believe. The whole basis for this trade was a little shaky to begin with, right? It's gone well, but I think the basis for the trade. Also, I am starting to see like some selling in ZB. So that's another thing we got to keep an eye on. There could be some steepening coming through. Well, you know, I was just thinking with my whole rant about, like, do we have empirical research? Maybe what we should do is we should see if we can find some empirical research that's interesting today, huh? And they're still kind of having a hard time keeping 28. I'm a little bit worried about that. I don't know. I'm not so sure about if it comes back to 25 either, so. Qubit swap. Informational edge in decentralized exchanges. Optimal execution and macroscopic market making. Maximizing battery storage. Okay, that's a weird market to be trading. Belligerent says low archive. I know it's the greatest, right? Optimal execution in intraday energy markets under a Hawks process with a transient impact. Well, there's studies about Hawks processes and transient impacts, so I kind of feel like this one it might not be so interesting, but information leakages in the green bond market. What's the green bond market? That sounds like something I should know. Oh, here you go. Can large language models trade? I have seen so many people popping into the trading subreddits, or sorry, like the quant subreddits, being like, oh, I tried it this one day and it was absolutely amazing. Bethesda is announcing the Oblivion remaster today at 8. Okay. This paper presents a realistic simulated stock market where large language models act as heterogeneous competing trading agents. Oh, okay. So they're not testing it against the real market. They are making up a market that's they're making a market up that contains multiple LLMs. The open source framework incorporates a persistent order book with market and limit orders, partial fills, dividends, and equilibrium clearing alongside agents with varied strategies, information sets, and endowments. Agents submit standardized decisions using structured outputs and function calls while expressing their reasoning in natural language. Okay, so I don't like that it's like I would prefer to see like how good does the LLM do at just trading the market, but creating a market entirely of LLMs is, I think, really important research to be doing, because, you know, like agent-based modeling is a budding source of research, an area that's really taking off. And if you can use LLMs as the agents, then that really makes things easier. That makes that research easier to do, right? And they were doing so with an open source framework. So we could potentially duplicate their research. Right? Okay. 3 findings emerge. First, large language models demonstrate consistent strategy adherence and can function as value investors, momentum traders, or market makers per their instructions. Second, market dynamics exhibit features of real financial markets, including price discovery, bubbles, underreaction, and strategic liquidity provision. Third, the framework enables analysis of LLM's responses to varying market conditions, similar to partial dependence plots in machine learning interpretability. Okay, I did not understand what that meant. Enables responses to varying market conditions similar to partial dependence plots in machine learning interpretability. The framework, oh, okay, so basically they're saying that the LLMs do something that machine learning algorithms do, which is good. That means that they can actually, that the LLMs can actually be relatively advanced agents. And this just from telling them become a liquidity provider or whatever. Okay. The framework allows simulating financial theories without closed form solutions, creating experimental designs that would be costly with human participants, and establishing how prompts can generate correlated behaviors affecting market stability. Okay, so I really like this. I don't know if this one, well, let's just save it. Let's save this paper. Save that one. That I might like not read it for like not get to it for like a year. Do you know about oflib and how we can use it? Wait, is the lib, was there a typo there, or is it called oflib? I don't know. I think the answer is no. I think the answer is no. Did we get a higher high? No, not quite. They did trade into 29 though. Okay, optimal execution in macroscopic market making. We propose a stochastic game modeling the strategic interaction between market makers and traders of optimal execution type. Oh, okay, so they got a market maker and they've got like a trader that is trying to do optimal execution. Okay. Or trade, so maybe they say we're gonna buy, but you're gonna buy most optimally, right? For traders, the permanent price impact commonly attributed to them is replaced by quoting strategies implemented by market makers. For market makers, order flows become endogenous, driven by tactical traders rather than assumed I don't know how to say that. I know what the word is because there's endogenously, but this is exogenously. So they're saying rather than you start to assume that is just the trader's going to trade rather than that there's some informed trader out there. Essentially. Using the forward-backward stochastic differential equation, characterization of Nash equilibria, we establish a local well-posedness result for the general game. In the specific Almgren-Chris, whoa, wait, what is Almgren-Chris Alvalanda Starkliv? Because I know Almgren-Chris, but this other part is there been another innovation in this that I'm not familiar with. A decoupling approach guarantees the global well-posedness of the FBSDE system via the well-posedness of an associated backward stochastic equation. Wow. This one is way over my head, guys. Finally, by introducing small diffusion terms into the inventory process, global well-posedness is achieved for the approximation game. So I'm not quite sure I understand what you gain from this. Oh, well, that's funny. When I search for that word, I just get the study that we just read about. Okay. A comprehensive guide to Avalanda and Stoikov's market-making strategy. Oh, okay. Oh, okay. So Almgren-Chris is the optimal execution, and Avalanda and Stoikov's market-making is a market-making strategy. Okay. The brand new and this was 2021. Brand new strategy arrived with the latest Hummingbot release. Is that a that must be a framework. That must be something that somebody is selling. Open source framework for crypto market makers. Oh, I see. Okay. But it's a Python library. Avellaneda and Stoikov talked about a market maker's two main concerns: dealing with inventory risk and finding the optimal bid and ask spreads. Yes, after going through some mathematical modeling, they arrive at two formulas that help market makers solve these problems: a reservation price and optimal bid and ask spread. This sounds familiar. Maybe they talk about this in Trades, Quotes, and Prices, and I don't remember it. This one in particular sounds really familiar. Where S is the current market mid price. S minus Q, the quantity of assets in inventory. Y, inventory risk aversion parameter. Market volatility. T, closing time, current time. Oh, okay. So you say the current price minus, and then you're taking how much inventory you have, how much you care about how much inventory you have, and the square of market volatility. So market volatility factors into that significantly. And then that determines, what is it? Oh, it's the R of SQT. Okay, but then the optimal bid and ask spread is, yeah, the bid plus the ask is equal to inventory risk aversion times the volatility squared times the time. This is like, you know, the time that you're looking forward to, like 30 minutes or whatever. 2 over the inventory risk parameter times the ln of 1 plus inventory risk parameter again over K, order book liquidity. Okay. So what can we glean from that? This I am pretty sure that this is in the book. It's basically, you were saying how much volatility there is going to factor significantly into how much liquidity the market makers put up. Well, I could have told you that, but there it is, like expressed in math and showing that when you use that it works better, essentially. Well, let's keep reading anyways. Basic strategy for market making is to create symmetrical bid and ask orders around the market mid price. But this kind of approach, depending on the market situation, might lead to the market maker inventory skewing in one direction, putting the trader in a wrong position as the asset value moves against him. Avellaneda and Stoikov approached the inventory risk problem by calculating a new reference price where the buy and sell orders will be created around based on 3 main factors: how distant is the trader's current inventory position is from the target position, Q. Oh, okay. The value of Q on the formula measures how many units the market maker inventory is from the desired target. Did they say that over here? Quantity of assets in inventory of base asset could be positive or negative for long short positions. Okay. So this is would basically be like expressed in dollars, potentially. That's interesting. In other words, when we come over and, oh, this might be an interesting study to do. As we get further away from these inventory cost basis lines, the amount of liquidity being put up should decrease. Maybe something we could test sometime. How much inventory risk does the trader want to take? This parameter is a value that must be defined by the market maker considering how much inventory risk he's willing to be exposed. That is basically like how much money do we have to trade, right? Time until the trading session ends. The model is, oh, okay. But it might also be like time until news is released. Could also do that, right? I wonder. So like we could. So interestingly enough, this is all based on the current mid price, right? Which means we could make this and have it trade on like micro treasury yield futures, like with the ones that don't have any liquidity, and have it go just based off of the mid price potentially. I think if I were to do it like on the 30-year, that would definitely not work. Oh, that's not enough for you to even see, for it to have even seen. But like on this one, there is a, wow, a 17 tick difference. So if I did it based off of the mid price, well, you might be able to, but the thing is the like the actual true price, like if I were to go on to the bonds exchange, I forget the name of it, but the bond exchange that the CME uses that these are based off of, and looked at the actual yield of the 2-year, you know, like there's often like a difference of 10 ticks, but it could be between 76 and 770, but it could also be between this 75.5 and 76.5. So depending on if I put it here or there, I could be putting out really bad liquidity that would get picked off. But it's close enough that we might be able to do it. And I had kind of talked about doing this before. But that's not it. There you are. That might be interesting. Okay. What happens if you put it in and you say you only want one contract's worth of risk? What does it do? That'd be interesting. Watch. What is the order book liquidity density? There's a lot of mathematical detail in the paper explaining how they arrive at this factor by assuming exponential arrival rates. There are many different models around with varying methodologies on how to calculate the value, but for now it is essential to know that using a significant K value, you're assuming that the order book is denser and your optimal spread will have to be smaller since there is more competition on the market. On the other hand, using a smaller K, you are assuming the order book has low liquidity and you can use a more extensive spread, which is what we would be doing in this instance. Here's where the magic happens. The execution logic of the model is pretty simple. Calculate the reservation price based on what is the target inventory, calculate the optimal bid and ask spread, create market orders using the reservation price as a reference. I don't think that means like you place a market order, but just like you place limit orders using the reservation price. Bid offer price equals reservation price minus optimal spread plus optimal spread. Yeah. I like it. Probably. So my guess is if we did that, and we put it on the 2-year, that the prices that it would get would be similar to the ones that are already being put on there. And then if we were to go in and say, I'm willing to take on more risk, essentially, then we could get it closer. So in order for this, the spread in the 2-year micro yields to become smaller, you need more people willing to take risk in that instrument. Aha. More market makers willing to take risk in that instrument. Well, I think I'm willing to put a couple $1,000s into it for the sake of the market. Because I think that having micro yield futures, the liquid and something that people trade and like retail traders doing spread trades frequently, is something that would be valuable to the market. Cool. Okay, so we got something from that, but there's one more. Now, what they were getting out of this, I don't know. I don't know what they're saying here, but whatever. Information leakages in the green bond market. Public announcement dates are used in the green bond literature to measure equity market reactions to upcoming green bond issues.
Order canceled.
Oh, that was the exit. Okay. So it didn't make as much as we would like, but it did make a little bit. S&P 500 is taken off here. Oh, is it really? Okay. Oh, no, wait. That doesn't make sense. I see. It's seeing another impulse already. Huh. Well, that's interesting. Maybe I should change the robot's logic to say, if it's been an hour, but it's still showing a general imbalance, like don't get out until it gets back below 53 or something like that. Because in this instance, it just happened that we were crossing over 53, like just then. So I'm a little concerned when it gets out of a position and then immediately gets in one, but in that case, it was just a coincidence. Okay, cool. Let's see here. We find a sizable number of green bond announcements were predated by anonymous information leakages on Bloomberg Terminal. From a candidate set of 2,000 Bloomberg News and Bloomberg First World headlines gathered between 2016 and 2022, we identified 259 instances of green bond-related information being released before being publicly announced by the issuing firm. Okay, so green bond must be a corporate bond that is just being issued. Gotcha. These pre-announcement leaks significantly alter the equity trading dynamics of the issuing firms over the intraday and daily event windows. Significant negative abnormal returns and increased trading volumes are observed following news leaks about upcoming green bond issues. These negative investor reactions are concentrated amongst financial firms, and leaks that arrive pre-market or early in market trading. We find equity price movements following news leaks can be explained to a greater degree than following public announcements. Sectoral differences are also observed in the key drivers behind the investor reactions to the green bond leaks by non-financials. Oh, okay, so wait. Man, why does my nose itch so much? Are they saying that the market moves more when the information is leaked than when it comes out in the way that it's supposed to? That's interesting. But makes complete sense to me too. Because one, market makers aren't expecting it. So they might, when they see the flow come in, they might kind of freak out. And two, traders will think that there's more edge available there. So they're more likely to trade it. Our results suggest that information leakages have a strong impact on market behavior and should be accounted for in green bond literature. Our findings also have broader ramifications for financial literature going forward. Privileged access to financially material information courtesy of the ubiquitous use of Bloomberg terminals by professional investors, highlights the need for event studies to consider wider sets of communication channels to confirm the date at which information first becomes available. Interesting. I'm gonna blow my nose here. Oh, wait, I didn't notice. Fed's Harker speaking. The Fed has built up a lot of credibility over time. So there is a little bit of a rumbling of stuff going around, but now President LaGuardia is going to be speaking on CNBC. Huh. You know, when I look at the chart, it looks like a really good, clean uptrend. It's just like it's such a narrow range throughout it. This feels like an ascending triangle. You wouldn't see that on the chart, but I do kind of see this thing where it's like they keep coming up to this 29 and backing off of it. That was grandma coming. She's been watching the kids during the day. She's like, "Oh, it's time for you to go. Aren't you supposed to go?" No, I got 5 minutes. But I didn't realize there were 5 minutes. Boy, so that's good. That means that I should probably on my discretionary trade here that I probably should just take the 28 half for the 29. And then we'll leave and it will just skyrocket out of here, and they'll be like, "Oh my gosh, if we had been able to stick around for that would have been like $1,000 trade." And it's always how it goes. They keep putting up MBO offers in ZT, holding back on up move. Okay. Well, I kind of wonder if that is which side of it is, though, right? Like, are they putting up the offers because it's not going, or is that the thing preventing it from going? And it's hard for me to know with ZT, because in ZT, a lot of that liquidity is not real. It's just people put big amounts of liquidity on there so they can get the partial fills. Okay, well, I was able to get out at 28.5. That's pretty good. Like as far as the trade goes, that's not bad. Let's see here. It went 5 ticks in favor, so I only missed 1 tick on there. It did go 3 ticks away from me on the other side, though. So I probably could have made 3 ticks more. That would have been a lot better. That would be almost double, right? There's like those little, when in this kind of like normal market, I would consider this like normal market conditions. Like there is something going on, but it's not huge, right? And this is probably prime action for like small scalps, right? So like the difference between 7 ticks and 4 ticks. Yeah, it makes a big difference. Let's see here. Did I miss? Oh, I missed Vital's question here. Do options info about the high volume on certain price levels help with futures trading? So, like knowing which strike prices have the most open interest open at them. In futures trading, like especially here in the treasuries, I don't necessarily find that to be super predictive of anything. Because it's you know, it's basically at every half strike, and like you can usually guess where it's going to be. You can usually guess where it's going to be. But once you start to take into account all the other information, like you aggregate together where everybody's existing positions are from and everything, and calculate like cam exposure and things like that, that's where that sort of thinking can start to become powerful. Well, I got out at exactly the right time because it's starting to come back down. Well, I guess we should start the output timer, and we'll leave the stream going. I'll do it one more time. Oh, no, wait.